What's going on, Wildcatters? We've been launching a lot of new shows. Obviously, the market is kind of been a shit show. It's been extremely volatile over the past few months. One of our buddies, Big George, I can't pronounce his last name.
Big George.
This is really the genesis of a new show with Big George called Markets, Musings, and Miscellaneous. And George is extremely knowledgeable about all things commodities. He's a former trader, physical and paper trader.
Yeah.
Right. And so he was kind of our go-to. We had a lot of people asking us questions like when oil hit negative like $46 a barrel, what the hell was going on with that? And so George was our kind of go-to resource. And we said, you're entertaining, you're extremely knowledgeable. Let's kick off a new show with you and see how it goes. And so here we are. Also, we trained jiu-jitsu with him. I don't know if I mentioned that yet.
Yeah, all the jiu-jitsu bros.
All the jiu-jitsu bros. We're slowly wrapping them into the fold of digital wildcatters. So, George, welcome to your own show.
Oh, thanks. I don't know about the entertaining part. Hopefully it'll be a good exchange.
So let's talk about, when we had negative $40 oil prices the other day, you came in our office and you're kind of giving us the lowdown of, first how prices go negative. Right. So let's talk about that first, because I think that's a great entry point of how do prices even go negative? Why was it allowed? You were telling me some things like man, the rules of the market changed last minute. So let's start there and talk about that.
Sure. You just basically had a perfect storm of bearish sentiment, price action, and then literally like hiccups in the mechanics of like markets, paper markets, electronic markets that just allowed for essentially everything to fall off a cliff. Commodities broker series 3 101 is it's more dangerous to short something or sell it naked, not own it, sell it before you own it, versus buying it outright. Because if you buy something outright, your risk theoretically should be limited to zero.
Yeah, should be able to go to zero.
You buy something at $10, it should only lose $10, even if you're buying 1,000 things at $10.
Yeah.
You sell something at $10.50, it could go to infinity in 50 cents. So
essentially you have unlimited upside, right?
Unlimited downside if you're shorting, or if you're long, hypothetically, theoretically. But if you own something, your downside theoretically was always limited to zero.
Capped, yeah.
There's times in commodities markets. There was a cabbage crash in 1953 in Chicago.
A cabbage crash?
Yeah, we're literally, because it was analogous to oil in the sense that I was calling this storage Mageddon. This is the third time it happened. The Saudis were over pumping in 2014 to try to squeeze out the shale producers and get back market share. They thought they could kind of choke them out. If crude was oscillating between $80 and $100 for 4 years. $115 is the top tick. After the 08, 150-ish, depending on what you were looking at.
Those were the good days.
Yeah, exactly. So literally it went to $148, and it crashed to 30 in the 08, everything crashed. Then over 2 years, 2011, it's back up to about 115. And then the Brent contract almost went over 145 again because because Iranian oil got taken off the global market, and we still couldn't export crude, but we had all this crude coming on that had to be landlocked domestically. And the only way you could get it out of the country was refine it and send it out as refined products. So that essentially made millionaires and billionaires out of anybody who had a truck, because if you could get it in Bakken at the wellhead for $12 a barrel, and you could somehow get it to the coast, you'd get paid a premium of $30 over what West Texas Intermediate would do. And plus all the pipes were running north from the Gulf Coast. We're a net consumer of petroleum and energy. So we don't make as much as we consume.
Yeah.
And so Seaway was the first pipeline, and Capline. Seaway was the first pipeline to get reversed. And now you have all these other pipelines that are coming from the West Texas. You obviously have Bakken, South Texas, which is really close to the coast. And they kind of tack on, or of those pipes that are coming from Midland, they kind of connect in through there.
Yeah.
And then you got all sorts of pipelines up in the Rockies that are feeding the Midwest and other that. So the dynamic changed where everything was kind of coming in from the Gulf Coast and going up into essentially the country via pipes, and then into refining and into gasoline in your car. But now when all the production was coming from the land, there was a way to get it back. So anyway, so I go through that spiel to say, it went up, traded. The Saudis didn't like it because we're getting market share, and they were always the biggest guy on the block. Not necessarily because they produce the most, but because they're the biggest swing producer, because they don't consume near as much as they produce.
Yeah.
They are still the biggest OPEC producer. So anyway, you go through that spiel to say they thought they could choke them out around 50, 60, 70 bucks a barrel, but they overshot it. Free markets, resiliency. Find out that, producers really just want to keep the lights on, and that cost is around 30 bucks a barrel, as opposed to making a nice, healthy profit margin. They had to make 70 to pay their debt covenants, keep the lights on, and then take a little home.
Yeah, 30's just cover
30 was
cost
just
basis,
cash flow,
Yeah.
just to keep the lights on, because once you shut in wells, especially fracked wells, those don't come back.
Yeah.
You have to, not only do they decline precipitatively, but if you shut them in prematurely before their decline, you'd be lucky to get their decline.
Yeah, it's
rates.
actually a pretty hot topic about what happens to shale wells as they're shut in and brought back online, because there's not a lot of back, cases.
I've heard some of the opposite, to where they're saying that some of the built up back pressure was actually bringing them back online.
Yeah.
15-20%.
Yep, that frac matrix, from the reading, now I'm not a geologist, but I've talked with a couple of them that are pretty astute. Once you cause that frac matrix and you literally have it, and it's almost like people frac wells all the time, and even if there's stuff around, they're not doing it right, or just, the well doesn't make it, comes up with too much water due to the porosity or the different variations of the rock. But once you've got it, it's almost like, okay, here we go. It's there. If you do anything to shut it in, meaning shut it in, the pressure that has to be maintained via the proppant, the water, this, that, and then the pressure, just to keep everything in place. Once that collapses, if you try to reinflate that balloon, it comes back in a chaotic subversion of itself.
Yeah.
So this is more a geological thing. The take home is that
Shit can change.
right now the consensus is those things drop off a cliff, and then not only that, if you shut them in prematurely and then try to kick them back up, they don't come back on like they were.
Well, the problem is shale wells already fall off a cliff in terms of
Exactly.
very steep.
Yeah.
So you got a lot of moving
Declines,
parts here.
yeah.
So
Yeah.
so all I'm getting at is that, those guys don't shut in at all, and even in these really depressed prices, they're doing their best not to shut in and keep the lights on. So what does that mean? Good old USA #1, free and open markets, but we didn't go away, and so the kingdom then had a lot of problems with that, because they thought this would have been a year or two thing, and it ended up just dribbling along the bottom.
For them, they've been dipping into their sovereign wealth fund, which funds all of the operations of
Absolutely.
Saudi Arabia, and they realize that they've been having their vision fund and wanting to. Maybe that was Saudi. What's the Saudis have their own little thing that it was like Saudi 2040 or something.
Yeah, well, that was a new
their new vision of like diversifying outside of oil.
But even before that, Kissinger went under the Nixon administration, and one of the three pegs that makes the dollar the reserve currency of the world, and why we get things ostensibly cheaper than anybody, is that if you want to buy a shirt, you have to change Thai baht to USD to buy it, hypothetically.
Yeah.
I mean, I'm sure there's people who can buy it for Thai baht in Thailand. But every barrel of oil that's traded around the globe, whether it's a barrel in China, traded in China, or Singapore, or in Britain, you have now the yuan, the Singapore dollar, you have, the pound, all traded in USD. And they did that a couple of ways. The Saudis set that precedent via the Nixon administration. Henry Kissinger went there. And they said, because you are a net producer, everything you will make in surplus after you buy your diamond encrusted Rolls Royces and stuff like that, and your
cheetahs.
Yeah. So after you buy all that stuff, you're going to house any excesses in USD and dollar denominated assets. So that built like a little nest egg, and that's why the petrodollar, one of the three pegs, is the petrodollar. Well, if they had $1 trillion US, and the kingdom needs $100 a barrel just to keep the kingdom open, they literally were trying to play a little bit of a long game here, and they just didn't anticipate it as going as long as it did. Due to shale producer resiliency, just for screw you, we're gonna
on the front end, try to
Yeah.
collapse our market.
So they were,
and get
yeah,
market
and
share.
so they were literally burning through their reserves so fast that 2015 was the first year in the history of the kingdom that sovereign debt was issued. Like the U.S. government issues 30-year bonds to people because we run budget deficits. So the first year in the history of the kingdom. And so that's why that Saudi 2030 or whatever it is with that bin Salman, the new guy, is so important because they're realizing that they can't live and die on that forever. Because they're seeing that they're seeing the sunset as far as their ability to sway the oil market. So that was Storage Mageddon 1.0. We're all going to fill up with crude oil. That didn't happen. Then in 2016, it happened again. The Saudis tried to give it another go, drove prices even lower from like $30 to like $26. Then it bounced, demand snapped back, things were ostensibly better. But now you have this perfect storm where, because they couldn't weather the storm as long, they colluded with Russia. So they had OPEC and Russia collude to price production quotas. And you always have that problem with, okay, are people really going to be honest, you know? And they are for a time, and then once the getting's good, everybody welches and kind of overproduces, and then that kind of manifests itself in the data and cargoes that land.
Yeah.
And they're like, oh, they have been overproducing, and now you're kind of flush with oil. So that literally is that production quota that got started in 2016, which was at the end of Storage Mageddon 2.0, literally through back channels or whatever, just retrospective analysis, they saw that the Russians were chirping and poaching. They were over pumping, and they went on the warpath at the beginning of March and said, we're slashing prices and we're upping production. To where even the OSP, the official selling price for February delivery, before they made this announcement, got revised down. So if you happen to buy barrels of Basra Light or whatever grade that came from Saudi Arabia or any part of not every part of the Middle East, but part of those countries in and around there, it's like, hey, you just got an extra price deduction on your barrels just because that's how hell bent with that. Well, who knew? A lot of people kind of knew about COVID, but that necessarily caused our demand and the world's demand to fall off a cliff. So now you have this, we're gonna go for broke for a third time, but it's like, oh, there's nobody there to eat it. And so now it really overshot.
Yeah, so they initiate this pricing war, but they didn't take into consideration COVID.
Well, even if they knew about it,
how could they?
Yeah.
And so they do it, and then they're like, oh shit.
I mean, COVID's a SARS virus. Like, it's called SARS. To all the virologists, they call it SARS-CoV-2, which means back in the early 2000s when we saw the people in Asian countries with masks on, they were dealing with that, but that was just way far away.
Yeah.
Well, now it's visited our shores, right?
Yeah.
So maybe they thought it was, I'm speculating here, maybe they thought it was localized.
Yeah.
But it clearly, say what you want about how dangerous it is, I have my own opinions.
Yeah.
Nevertheless, it caused people to
When I first heard about it, I didn't expect it to make it to our shores the way that it did.
Yeah. But even if it did...
It doesn't matter what you think about COVID, it had economic impact.
Absolutely.
Right?
So whether you believe that we should have shut down, we did.
So global demand was at 100 million barrels a day, and now it's down to 65?
It's at least a quarter, possibly a third. Who knows where it all, because these things are all retrospective 2 or 3 months later.
Yeah.
Nevertheless, I mean, everybody thought, the premise for sentiment is if there's 91 million barrels of storage in Cushing, Oklahoma, if it's at 91 million point oh and one more barrel comes in, that's enough, should be enough to send prices to zero. Like, that's how, even if markets are robust due to liquidity and then ample excess capacity, this, that, and the other, if you feel that it will start to spill on the ground, that barrel is worthless.
Mm-hmm. Yeah, so let's say, we have this perfect storm that it's brewing, you have the pricing war, and then you have
so
demand
everything we said set up sentiment, right?
Yeah.
So we have sentiment bad, okay? Then the other side was that this happened post options expiration. So options always expire 3 days before the contract expires. So any sort of
Can you unpack that a little bit? You know, for someone like me that's not a trader.
Yeah.
You know, what are the options?
So an option is like, if you want it, like you said, if you think oil's going to $50 and it's at 10, you buy it, but you could lose 10, right? Conversely, if crude oil's at $10 and you think it's going to 0, you sell it, you make 10, hypothetically. Or excuse me, make 40 to 50 anyway. An option, if you just don't want to take the outright risk, you buy an option which literally has a strike price and it has a time, it's insurance. So it literally has like a 6-month policy, but you can buy a 1 month, a 1 week, a 6 month, a 1 year, and they get more expensive. And then they also have strikes. So if crude oil is going to $10 or to the 10, and you think it's going to 50 in the next 2 years, and you don't want to buy it at 10, you could buy a $15 or $20 strike, call the right to own it, and pay a premium. And somebody takes that money because they're betting that it won't. In the event that it goes to 50 and you own it at the 20 strike for $10, anything over 30, because you pay your premium, so you have your strike plus your premium.
Yeah. So
and that's called your at the money. And then anything like that is called at the money or in the money.
Yeah.
Okay, so that's a call, and a put's the exact opposite.
Yeah.
So those puts and calls options, they expire, and I'm
3 days before.
3 days before the contract. So you literally can go in the futures markets and buy July's trading. You can buy a July option that expires sometime June 21 for July delivery. You can buy in August. You can buy all of these, and they expire when when that contract or when that options is set to expire, which is by not law but by regs or by rules, 3 days before. So you have options expiration. So all the people who might have owned puts, if you owned a $20 put and it settled at 1938, okay, you made 68 cents. The option cost you $4, lost $3, whatever, $3.30. Okay, those are all gone now. So like literally, so you had that options expiry, and then you have, because retail or front end people can buy and sell. At the end of the day, the futures markets were made to get price discovery, open outcry back to the physical.
Yeah.
And everybody can cash their lots, and even people who want to speculate. But at the end of the day, speculators normally can't take delivery if you're not a physical player.
Yeah.
If you own tankage or own production,
I don't have a fucking tanker to pick up that.
or own a tank that's connected to a pipe, or have production because it's kind of a tank in the ground, right?
Yeah.
At the end of the day, once you're touching physical barrels via a tank or you're a producer, or even if you're a refiner who has to buy it, you're a physical player.
Yeah.
You or me, there are trade shops, hedge funds, and all they are is computer screens and bank accounts full of money and trading accounts.
Yeah.
And they buy or sell, but they cover, because at the end of the day they can't take
they don't want to take delivery of physical oil. Yeah.
They can't.
Yeah. Just like me and you can.
Exactly.
It's like go up there in my fucking pickup.
So you had this,
That's some barrels and
so you had that. The second part of the storm was that you'd think that all the players in the market were smart enough, but apparently there were these funds that were super long, bottom pickers, saying, oh my God, it's $20 oil, $17 oil, we haven't seen this since the 80s. Mm-hmm. So they were bottom picking. There was no ability to hedge it via options, because you use options. Even if you don't like to trade options for profit, you can use options to hedge.
You use them to hedge. So let's just paint a picture. These guys are coming in, they're seeing $17, $18 oil. They're buying these contracts naked, right? They have no options.
They can't hedge.
Yeah.
And then you have, now the backdrop is weak demand. Oversupply, weak demand. Falling off, not only that, but it's accelerating, right? We don't know where it's going to land. We know that production is coming via the Saudis, and prices are being slashed, and we know that people are staying at home and not flying. So you have those two, that's set in sentiment. And so you have them naturally long, long, weak longs, because they can't take delivery. And then you have this X variable that, because of the price weakening and then the CME saying that there's this thing called the Baclier model, which They said they started to reserve the switch, or reserve the right to switch to it. And I'm still looking for this email.
What is the model called?
It's called Bachelier.
Alright, so the Bachelier model, this is where they essentially change the rules on the fly, right?
On the fly, while maintaining, still looking for this email.
Is that legal?
So that's the
When you control the rules,
that's the
then-
$1 billion question, right?
I mean, who is the CME held accountable to?
I said it's CC, right?
Well, the CME is a privately owned institution, right? And so they have their rules for dealing with it, and for dealing, contractually, people have to post margin with the exchange. You own a seat on the exchange. Who knows what those legal machinations or inner workings are? At the end of the day, there's a lot of people who play in that sandbox because they own the biggest, paper contract, at least in the U.S. For domestic supply, and a lot of people got left holding the bag, so to speak, because they actually said that they issued an email. Like I said, I'm on their list, and I'm getting all sorts of emails about some instrument that I don't even care about. How trading.
Never got any email about
Trading
this.
and stock, yeah, and I'm like looking, I couldn't sign this, but apparently it was circulated after the fact, how convenient, that they reserved the right at $8 to $11 a settle, and that they could flip the switch then. So like they were given notice. Well, crude starts at $19 the day before expiration, but options have expired one day prior. And you have all these funds net long with inability to take delivery, and then you got the algos just sitting there, algorithmic trading shops, which is essentially computer run trading, just seeing what the last 10 trades and the next 5 trades do, and then they kind of essentially glom onto that, and then that could last for 10 minutes or 10 years or 10 hours or whatever. And so in this case, it lasted for about 3 hours of horror if you were long. And
we have a pricing screen in our office where we can see CME futures, and I mean, it was just like for an hour, it just fucking dropped. I mean, when it actually went to -40, I mean, it was like.
Well, I know that CME, but that's got a 5 minute or 5 or 10 minute delay.
Yeah,
like
10 minute.
Okay, what I'm getting at is I saw it on the screen real time, and
Yeah.
I actually had one of a front end application that didn't shut down. A lot of traders or smaller trade shops use interactive brokers. Their screen went blank. So even if you were short, you didn't even know what was going on.
Damn.
And they weren't even letting you cover. That's
Can you
a
imagine just the madness? It would be like, what the fuck?
yeah. I mean, at least when it happened with me, I was like, I'm buying -40, and got buzzed out, called like, yeah, we're not letting you buy -40. And I go, why not?
Someone saved you from yourself.
No. I bought -40 all day long. Somebody's paying me $40 to take a delivery of a barrel of oil.
Yeah.
I mean, I'm losing at -80. I'm breaking even at -80. If somebody's paying me 40, I have to lose another 40
Yeah.
to break even. So I'm taking that one.
Yeah.
So
So they literally called you?
oh, no, I called them as to why I couldn't.
I'm guessing
I just
had pretty good customer support if you can just.
I just wanted to buy 2. I mean, I just wanted to buy 2. First of all, how do you margin requirement that, right? Because margin requirements have blown out now. Like literally, to put a contract, it's like literally 2/3 what the contract's worth. You might as well own it outright.
Yeah.
Okay, but like used to be, it was like 10%
Yeah.
or something to that effect.
Yeah, why didn't you need any margin?
Yeah. So how do you calculate margin on something that's worth negative? So anyway, I mean, is the potential bottom at negative infinity now?
Yeah.
Here we go. So a lot of questions get asked. Who knows where that all shakes out? But so you have 3 things: the bad sentiment of the overproduction from the Saudis, fundamentally. Then you had it double whammied with consumption falling off a cliff. You have the weak longs who are trying to bottom pick. And then you have the actual arbiters of market institutions via the CME who are supposed to keep the rules fair. They are the trusted third party. This is why the crypto anarchists and the blockchain people are getting traction, because banks and exchanges that are supposed to be unbiased, trusting third parties now are pulling like horseshit shenanigans on the fly.
Yeah.
And people are
How
getting,
can you play the game if you can't trust
yeah, the
refs,
the chief.
Yeah,
the
it's like-
chief. Like,
yeah.
Let me play devil's advocate though, because this is the first time in my knowledge that this has actually ever happened in history. So maybe they never anticipated that it was even possible in the first place.
but you still keep the rules. I mean, there's
Yeah.
been times, but now there's no consistency because the E-mini contract, which is the S&P, like has a fail-safe switch at minus 10%. So literally, it falls off at 10%. They halt trading.
They have
for like,
circuit. They have circuit
circuit breakers.
breakers.
They halt trade. They halt trading for an hour, and then they let it reopen again. And if it goes down, they'll halt it again.
Yeah, they allow.
And then literally, and bounces will
regain
happen. Then the bottom pickers come in, and it's almost like the flash crash in May of 2010 that happened. Like essentially set it because pension funds and 401ks are getting screwed with. And okay, you can paint these guys as big bad oil traders and oil companies that are evil, but listen, if rules apply, then they apply for everybody. If they don't, then there's no trust.
So why did they change the rules? Was it because they didn't know how to handle it logistically, or was it because they were going to lose money?
Well, I mean, who knows why? I mean, they don't lose money. They make transactional deal flow. So every deal that's done, they get a little bit, a little basis point, a penny, or whatever they get that your broker charges, and then that gets net back to the trade house or the FCM, and the FCM ultimately kicks it back to the exchange. Or people, there's big enough guys that can literally just trade on the exchange and trade through the exchange. The CME has a direct portal called CME Direct. And then there's, anyway. So all I'm getting at is that you literally have these guys that are ostensibly weak longs, because if you can't take delivery, then are you really long? And then who knows why they switched? There were rumblings that in the face of all this stuff that there may be, so there is that dynamic. I don't think physical players did that. Maybe they've tried to foresee it and try to get ahead, but they're like, if Cushing fills up and barrels start spilling on the floor, then there will be producers who are going to pay end users or refiners or trade shops to take it because they need to keep production going, like we said. And so maybe in their wisdom, they said, let's give a paper mechanism for that. First of all, that's horseshit, because diffs trade negative to the screen all the time. And if WTI is trading at $20, I saw when WTI was $28 and Hardesty, which is up in Canada, traded at, I think it was 28, I think I saw 19 under.
Yeah.
So somebody paid $9 a barrel.
Yeah.
So there's no reason to believe that if crude oil is $20 a barrel, that a physical differential at a market can't go negative 40 to that. And somebody will pay $20 to take it.
Yeah.
So I don't know what they were thinking. Maybe they thought they could capture some of that transactional business. But at the end of the day, it doesn't matter, because the notice that they gave was scant at best, and there were more.
Like how far ahead was this notice? Was it like an hour? Was it during?
It was like during.
It was so they actually switched it on the fly, because the $8 to $11 settle never happened.
Was it as soon as it hit negative, they were like, we're shutting down the shit down?
Who knows? I never got these emails. I've seen the one circulated that said they reserved the right at 8 to 11. But I'm
So
only
just imagine they changed this on the fly, right? And so all these hedge funds and institutions have these positions, and
they think they're capped at $1 at zero.
At zero. And then oil comes down and hits maybe $15 or whatever it is,
And they buy more.
And then
Or they buy more.
Yeah, they buy more. They're buying the dip, and they're buying, and then all of a sudden the fucking bottom falls out because you just got the rug pulled out from under you because the rules just changed.
And then maybe they're getting a call from the broker saying you need to flatten out, and it's like, and so then there was another thing where an old trading trick or just kind of paradigm is Contango, where if prices are really depressed on the front end of the curve of delivery, and then the back end they're kind of high, you can just essentially fill up a tank and buy the front end price, which is really cheap because of bad demand, oversupply, or whatever, and then you can sell it on paper and then just capture that spread. But these funds who didn't have tankage were scrambling now to somehow get tankage and take delivery. But because they don't have tankage in Cushing, which is the only place that the WTI contract can deliver, you have these funny like Mickey Mouse stories of there's some tank brokers where they auction off. You own a bunch of tanks, usually a pipeline company like an Enterprise or an Enbridge own a bunch of tanks in Cushing, Oklahoma. They don't use all of them. They have their own trade desks. They usually lease a lot of them out, and they make money like that.
You ever drove through Cushing?
I have once.
You drive through and it just smells like crude, like in the whole town.
I just can't believe how big it is.
Yeah.
So, and it's just in the middle of nowhere. But at the end of the day, you have these funny, like, one-off stories about how do I get a ship to Cushing, Oklahoma to take delivery.
So we're gonna take it up to Mississippi.
Yeah, exactly.
Hang on left.
Load it on some trailers, maybe. I don't know. VLCC too, 600,000 or whatever. It's like so. Obviously, somebody who's posing that kind of question
has no fucking clue.
Yeah,
like what's involved.
Yeah. Well, this guy didn't know about delivery to begin with. Oh, because they stumbled on Contango. Like, oh my gosh, if I own this at $10 and 12 months out, it's worth $48. I can make
$30 spread there.
And then my carry is only about $1.50 a barrel per month.
Yeah.
Oh my gosh, I'm still making $35 a barrel. I can't buy enough oil. Can I buy 10 million barrels to do that with? Where are you gonna put it?
Yeah.
Oh, I'll put it on a ship. How do I get it to Cushing? So literally, they're going through this, and the physical guys, whether it's the tank broker who put that out, they put it on LinkedIn or Twitter. They're obviously laughing. And then, but what it really shows you is that the people who were caught long didn't really know the danger that they were in.
Yeah.
And then CME really exacerbated it.
There's people fucking getting frac tanks out in West Texas.
Yeah.
Like I know someone that bought 500 frac tanks to store oil in.
Yeah.
Capture Contango, yeah.
Jesus Christ.
It
I
was
saw some
yeah,
small
500.
producers. The one who's hit us up like 8 times about their projects. I
Yeah,
saw
the thing,
them,
hey, but here's what,
producing
here's since we last talked, the curve is flat now.
That's what I was about to say. So
The curve is
because
flat.
this essentially, I mean, it has to, based on fundamentals, right? Like it has to flatten out because just think about this. Like in the early stages of Contango, like you have super Contango, right?
Uh-huh.
Where these guys are like, okay, I can buy it at this price, and then I have a $38 spread or whatever. Well, he's not the only one seeing that, right?
No, everybody.
So everyone's doing it, and so
Well,
the curve has to flatten.
But the curve actually did something very interesting because it was actually, when it first started falling off a cliff, it was still tight. It actually was only like $3. And then when everything fell out of bed, then it spread. And when it fell out of bed the first time, like in early March, and it went from like 42 to like 27 in a day, right? And then bounced a little bit, 35, and then went to 20 and 2-3 more days later. That spread, they actually presumed this is all the Contango we're gonna get. And so they already filled up the tanks, or a lot of them did.
Yeah.
And then when it really fell out of bed, and that's where Storage Mageddon started coming in, because if they weren't filling up the tanks, they were already making commitments to fill up the tanks and try to lock it in on paper. Barrels will flow later. You've already sold it on the futures markets. You've already locked in your Contango, and it's just like, because it's not going to go to, it can't go to zero, right? There's no way. There's no way it can go to, and I used to be one of those guys. There's no way it can do this. It's got to do this. And I literally go, it can do whatever the hell it wants to do.
Not only can it go to zero, it can go to
It can go
-40.
negative. So literally, if you'd have told me in theory it could have done that, I'd have been like, sure, because that's a mantra I changed with myself when I do analysis a long time ago. But my next follow-up would have been, how?
Yeah.
How?
Sure it can.
And obviously, we have some of the bits and pieces that cause it. So literally, to bring it full circle, you have this, and then the CME switching on the fly, and a lot of people got hurt. There were a handful of people, as always, with big market moves. There's a handful of big winners, and most of them are losers.
Yeah.
And most people donate to the big winners, and the big winners walk home, and maybe they write a book or whatever. But all I'm saying is a lot of people were not in the know. When you have the CEO of Continental Resources, who's a pretty savvy guy, you'd think, writes an official letter asking for an investigation. you know, obviously not everybody was in the know here.
Yeah.
So we'll see where that all, you know, comes out.
You talk about, you know, big dog, CEOs, billionaires, that are, you know,
got rid of $1 billion divorce check to his wife.
You know, referencing Harold Hamm here.
Yes.
And, you know, he's the Trump he's the Trump whisperer, man. He's Trump's best friend, and even he, you know,
Wrote an official letter.
How's this happening? So it's pretty interesting stuff. So, all right, man. Let's cut it short here.
Yeah.
I think we got a lot more to talk about, to dive into this, because it's such a complex topic, but hope you guys learned something today. We're going to have George on for some more shows soon, so be on the lookout.